In this month's Economic Update, Kaplan Professional Education's Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional's monthly economic update. I'm Michael Pollock, and today we're speaking with Head of Investment Strategy and Chief Economist at AMP Capital, Shane Oliver. Thanks for joining us today, Shane.
Pleasure, great to be here.
So firstly, let's take a look at the US. How do you expect the insular policies of the Trump administration to affect trade relations globally?
Well, I think that's the big fear in all of this, that there's a lot in Donald Trump's agenda which sounds positive for investment markets, and that's largely what's impacted so far. You know, talk of deregulation, tax cuts, infrastructure spending. Markets love all that sort of stuff. But the big fear since the election and before was always that he would embark on some sort of America first, protectionist, anti-trade sort of set of policies, and that would adversely affect global growth. That's why some people were talking about a recession if Donald Trump won, and ultimately adversely affect investment markets. But so far, it seems as if the pro-growth policies, the pro-business policies, seem to have dominated his anti-trade agenda. And if anything, he seems to have taken a softer approach on the trade front than may have been expected coming into this. Maybe it's because if you look at his team around him, you know, half are sort of very traditional pro-business, may have a bit of a different edge to them, but they're probably in deep argument, no doubt, with the others who are sort of this anti-trade or what I think Donald Trump calls fair trade sort of approach, and that's sort of leading to keeping a bit of a lid on here. There's also a bit of a learning experience going on. I think Donald Trump is maybe starting to learn that things are never quite as simple as he may have thought prior to the election. For example, if he slaps a tariff on China, China might retaliate, which would have adverse consequences for America, and they might also say, we're not going to buy any of your bonds anymore, which would make life very difficult for America. So I think all these things considered, he seems to be taking a softer approach.
So just turning to China, Shane, as trade friction with the US increases, what actions do you expect the Chinese authorities to take to sustain their stated growth target of 6.5%?
Well, the interesting thing with the growth target in China is that they used more flexible language. They said our target for this year, 2017, is around 6.5% and possibly higher. So there's a bit of flexibility there, suggesting that even if it was a little bit below 6.5%, that wouldn't be too bad. But a little bit below probably means 6.2, 6.3, so they don't want to go down too far. I think at the end of the day, there's still a lot of power in China to get the growth number they want, putting aside the usual cynicism that runs with the official growth numbers in China, and we can always cross-check that against demand for things like iron ore and coal and so on. But at the end of the day, if it looks like Chinese growth is faltering, and so far there's no signs of that, but if it does look like Chinese growth is faltering and they're not going to get growth of around 6.5%, then they could revert to renewed easing in monetary policy. Lately they've actually been tightening a little bit, and they could also further ramp up spending on infrastructure and the like, so boosting investment spending, and I guess there's still measures they could do to support consumer spending growth in China. So there's still plenty of scope for the Chinese to keep their economy growing along at the rate that they want. I think it's a very different situation to other parts of the world where the constraints are a lot more significant. The main risk in China, of course, is that they've got a lot of debt, but most of that debt is corporate debt, and most of it is debt of the state-owned enterprises. So in a way, it's very tied up with the government in the great scheme of things. But bear in mind, China's only borrowed from itself. It hasn't borrowed from the rest of the world. In fact, it lends to the rest of the world. So it's a very different situation to, say, a Greece or even Australia, which does rely on foreign lending.
Looking at Europe, populist parties have disrupted election campaigns throughout the region this year, increasing fears of a breakup of the Eurozone. Have these concerns been overblown, or is there a real chance of some members exiting?
I think there is a chance that some members might exit Europe, but I think the risks of that occurring are exaggerated by the media. We hear in Australia a lot about Brexit, but I often wonder whether people really knew why we hear a lot about that. I think it's largely because of our historic ties to Britain and our reliance on British news agencies to some degree. Yes, it's important for Britain, but the main issue for us in Australia was, would a Brexit lead to a breakup of the Eurozone? And of course, I think a lot of the commentary seems to say, well, the Eurozone, Europe is unnatural, it should break apart. But then again, if you're going to say that, you could say the same thing about the United States of America, because they're really just the same thing in a way. But if you think about it, Europeans are much more intertwined with each other. This whole Eurozone thing is really the tail end of 60 years worth of desire to get Europe closer together, head off the wars they saw in the run-up or up to World War II, to provide safety in numbers given the risk posed by the Soviet Union, perhaps now Russia, and in a world where America is sort of pulling back a little bit from global involvement to some degree, the argument for Europe to stay together is stronger than ever. And I think most Europeans reflect that. They say they're in the Euro, in the European Union, for that strength in numbers. Europeans tend to identify with the rest of Europe a lot more than the British ever did. And I think the other issue in all of this is that most Europeans, members of the Eurozone, the French, the Dutch, the Germans, even the Italians, most of them like the Euro. On average, 70% of Europeans say that the Euro is a good thing. And so therefore, when a populist party such as Marine Le Pen comes along and says, well, we want to get out of the Euro, we're going to reinstate the French franc, they may have some sympathies with the things that Marine Le Pen and other populists are saying, but when it gets to that bit where they think, well, we've got to leave the Euro, they think, well, that's not so good. Now, in the last few years, to be successful, and the only party that's done this has been Syriza in Greece, they've actually had to drop their plans to leave the Euro, and then out of all of that, they've just become another centrist party in Europe. So my feeling is that when you allow for the greater closeness and the commitment to Europe that you see from Eurozone countries, the fact that they like the Euro, those things suggest to me that ultimately Europe will hang together. But there's a lot of elections this year, France being the big one, maybe later this year Italy, and so it's going to remain in the headlines for some time to come. But I think ultimately it's going to provide opportunities, buying opportunities for investors.
And finally, to the domestic situation, what, in your opinion, can the government do to address housing affordability?
Well, I think the main issue here has always been supply. Now, a lot of people get tied up in knots about foreign buying and negative gearing and all those sorts of things, and they're probably playing a role. I'm quite sure they're playing a role. But at the end of the day, the big drivers of the surge in Australian property prices over the last 20 years has been the shift from high interest rates to low interest rates, which enabled us to borrow more and therefore pay each other more to buy a house, and an inadequate supply response. So we've got strong underlying demand. It's been accentuated by the ability to borrow more, negative gearing, capital gains tax discount, foreign buying, all around the edges. But normally you'd see a supply response. There would be more supply of dwellings out there, and we haven't seen an adequate response so far. Now, the last year or so, it started to appear. We've got cranes all over the place. That's good. But is it enough? I still have a sneaking suspicion that it's probably not. It's obviously very concentrated in some areas. It's apartments, not seeing a lot of single dwellings, which is what we really need. And I think the real issue here is to speed up the supply process, make it easier for developers to bring new land developments to the market, ease up some of the issues around infrastructure supply, longer term, try and get us to decentralise so we don't all congregate in Sydney, Melbourne, Brisbane, Canberra, Perth, Hobart, Adelaide, get out there in the regional centres. Those are the sort of things that need to be looked at. Now, obviously, anything which helps dampen down, in the very short term, investor demand a little bit. So there's an argument to look at the capital gains tax discount, which seems a bit excessive as far as I can tell. Look at ways to encourage people who enter the empty nester phase of their life to maybe downsize a bit faster. And that involves looking at pension rules and superannuation rules and so on. But I think some of the other solutions which are out there, like give more money to first home buyers by letting them access their super, or bigger grants to first home buyers, those things will all fail because they'll just mean, in this environment, yes, they've got more money to spend, that'll just mean higher house prices and won't really solve the problem. And I also worry that suggestion to allow people to access their super to buy houses will actually leave them worse off when they hit retirement, because the one huge thing about superannuation is that it relies on the power of compound interest. If you're not putting money away in the early years in your super, that compound interest won't do its magic by the time you retire to the same degree. So you can end up paying more for your house, as the baby boomers get the benefit of the higher funding that first home buyers have, but you'll end up with less in retirement. But to me, bottom line is deal with the supply side issues. That's the big one.
Thanks for your time today, Shane.
It's been my pleasure. Thanks for having me on the program.
That brings us to the end of the April PD sessions. Thanks for watching. If you have any feedback or questions, please drop us a line at pdcontent@kaplan.edu.au. I'm Ron Wilson. See you again next time.